Hey everybody, welcome back. This is our day 13 of our 15-day personal finance overhaul program. Today's topic is understanding the home mortgage. So let's get right into it. First of all, there are really good reasons to be a renter instead of a buyer. If you're there for a short-term period, 3 years, 4 years or less, you definitely are not going to appreciate any value in the property to cover the closing costs that are associated with most real estate transactions. So you're much more flexible to move in and out in a short period of time as a renter as opposed to becoming a homeowner. You may not be familiar with an area, so you may not want to stay very long. You may be a job hopper, moving all around, going where the money is, and you can't be tied down to a mortgage. And there may be those of you who are simply just not suited for all of the care and maintenance that a home requires. The yard work, the painting, the pipe repairs. Maybe you're just not handy. Maybe you're just not, that's not for you, and that's a great personal choice. And then the other thing that I would say, it's actually the third bullet down, is renting with the plans of becoming eventually a homeowner and saving while you're renting for what I call the right down payment. And the right down payment is 20% or more on your mortgage. And I would dare say 20% or more equity in the house. So 20% is a magic number. If you are not able to put down 20%, the banks will consider you a risky borrower. If you don't have the money to come up with 20% down, you may not be able to come up with the money to keep the house up, to pay all of the associated bills. You are a higher risk of foreclosure. To protect themselves from that, a mortgage that does not have at least 20% down or 20% equity in the house will require something called private mortgage insurance, or PMI. And it can add up to a couple $100 a month to your monthly mortgage price. If you're comfortable paying that extra premium for like the next 10 to 12 years until you get to 20% equity in the house, that's great. But if you don't want to pay the extra, then you simply save up and put 20% down. Now, let's talk about ownership. So the nice thing about ownership is it is yours. And every month when you make a payment, you're taking the money out of your left-hand pocket and putting a portion of it back into the right-hand pocket. The rest of it you give to the bank in the form of interest. But it is your house. Although the bank technically owns it, you are free to do whatever you want to that house. You can paint it, you can gut it and redesign the inside and put in a new kitchen and a bath and do whatever you want to do. It's your property. But the nicest thing from a financial standpoint is that it is appreciating in value. Now, that does change based upon location and type of neighborhood and how well you and your neighbors keep up your property. But on average, across the United States, residential real estate increases at 3.9% a year. That's a statistic I pulled off the web, not making that up out of thin air. 3.9% a year, your property is appreciating. And the beautiful thing is, regardless of how much you put down on your house, you are leveraging the total value of that house. So let's just say you put $10,000 down on a $200,000 house. That $200,000 is appreciating at 3.9%. Not your $10,000 cash outlay, but the total value of the house itself. So you're leveraging, right? Leverage, small amount of money, controlling a large value investment. You're leveraging a very sizable investment that is appreciating far more than what would be if you took that money and put it somewhere else. But there's also other tax advantages. So a lot of that money that you pay in your first, pretty much your first 1/3 to 1/2 of the term of your mortgage is in the form of interest back to the bank. Well, that interest is tax deductible. The government, again, punishes or rewards us financially through the tax code in order to get us to behave a certain way. The government wants you to be a property owner, and so therefore you are favored in the tax code by being able to deduct your property taxes. You're able to deduct your real estate or your mortgage insurance. There's several other things that they want you to do because homeowners generally tend to be stable. They take better care of their property. They're nicer to their neighbors. And it puts a lot of stability in the banking system to know that, hey, here's a mortgage that's borrowed money that is going to be repaid steadily over the next 15 to 30 years. So there's a lot of reasons why they want you to be a homeowner. And you will be rewarded for that in the tax code, right? Including the ability to buy a house, keep it for 5 years or more, take all of the capital gains, which means you're going to sell the house for more than you bought it for, and all of those gains as of 1997 are completely tax-free. So up to $250,000 for a single person, up to $500,000 for a married couple, and you can do that every 5 years. So it's very, very lucrative to be a homeowner, especially in areas that are appreciating, so that you can take advantage of this. Huge change from what used to be, but starting in what was called the Tax Relief Act of 1997. And then you see that with the advent of now being able to deduct your mortgage interest, you will now be doing what's called itemizing your return instead of taking the standard deduction, which is pretty generous. But now you see all of these different categories in which you can start to take advantage of tax deductions that you generally didn't have access to before because they just didn't add up to enough to offset the standard deduction. Now, with your mortgage interest payments, you definitely are beyond the standard deduction, and you can start to take a look at some of these other areas where you can make parts of your life more tax deductible than they were before. And again, this echoes back to, and I put it in here because I wanted you to be perfectly clear on this, the ability to sell a primary residence and keep the capital gains at zero tax rates. So you can exclude up to 250,000 as a single person or 500,000 as a couple in capital gains on a primary residence. You should look online, learn more about this, and talk with your financial or tax advisor if you think you're going to start taking advantage of this so you understand the rules and the time span, because it doesn't have to be 5 years continuous, for example. It can be, you could live in that house for any span of 5 years, even if you live there for 2, moved out, and then moved back in. As long as you live there for 5 years, you're eligible to take advantage of this. So check this out, because $0 capital gains is always a beautiful thing. All right, so here's our strategy for you to master your mortgage. Now that we know that there's times to rent and there's times to buy, and that there are key financial benefits to buying, let's go ahead and talk about you as a homeowner. So first and foremost, let's just do a snapshot, right? So this echoes back to what we did earlier. What is my status right now? So what do I owe on my mortgage? What is my interest rate? Am I still paying PMI? Was I ever paying PMI? Think about what your house really might be worth and find out how far along are you. Have you been making any extra payments, etc.? What is the going rate for your house? And then I want you to do a snapshot on the market. So now you know what your house is worth or what you think your house is worth. What are other houses going for? What are the other interest rates going for? Is it time to move or is it time to refinance? Are you doing fine and should you stay put? These are all personal decisions, but you come to these decisions after doing a good financial analysis to know what your status will be. And here's one of the things that I love to do is I love to play with numbers, and I love to play the what if game. So here what is something called a mortgage calculator. Everyone who has a mortgage should have this calculator. Some places call it a loan amortization schedule, where they break down on a month-by-month basis your monthly payment and how much of that payment is split between principal and interest and your ending balance. Now, why I like this particular one, and you see the website that I got it from in bold, www.mortgagecalculator.org. The reason that I like this one is for these two sections up here that say enter values and loan summary. It has a nice summary section. And the beautiful thing about this is that you can go in and manually put in some numbers and play with the numbers and say, well, what if I put a couple extra dollars in this month's payment? What if I put a few extra dollars in every single payment? What if I was thinking about refinancing to a new interest rate? How much would that really save me? So you can play these what if games by yourself and really, be shocked at the power of compounding interest over time. That is another phrase you should be familiar with. Compounding interest over time. It is astounding how much a little bit of money can grow, especially over a time span like a 30-year mortgage. And now I'm going to show you an example of that right now. Over on this chart, we said, okay, this is going to be, a $200,000 house at 4% interest, a 30-year mortgage, one payment a month for 12 payments a year. And you will see down on the bottom the total breakdown of how this works. Now, one of the things I want you to notice is every single month, a few more dollars goes towards principal, a few less goes towards interest. So it's a very off-kilter seesaw here that slowly starts to shift in your favor. And then you see the ending balance over time. Now, up top is a beautiful section called Loan Summary. And what you're looking for in this section is how many actual number of payments and your total amount of interest. Now, this is interesting. So for a $200,000 house, you're going to pay on $143,000 just in interest on this house. So your $200,000 house is actually $343,739, okay, when it's all paid off. But, and I added this little bit of interest save section over here. Watch what happens when I do something as simple as just throwing in a extra $100 a month. Now you're already paying $1,000 a month. You could probably come up with an extra 100, right? At some point, the hundreds become blended in as become pocket change, right? But I want you to see what happens with a simple $100 extra added to your principal payment. You'll see that over here in the loan summary section, you took your loan from 360 payments to 301. You took 59 payments off the back end of your loan just by paying an extra $100. You saved, just in interest alone, $26,000. Okay, so let's do some math. You paid an extra $30,000 out of your pocket. You shaved $26,000 in interest off the loan. You actually saved, in cash flow at least, a total of $56,000 off of your mortgage, right? Cash in your pocket, $26,000 in saved interest. But now, if you consider that you were going to pay $954 for another 59 months, you actually save $56,000 in cash flow. For $100 a month, look at the return on investment here. And the fact that you shaved your mortgage down, by 59 payments. So play with these numbers. Get excited. Get excited over what a little bit of money steadily invested over time can do for you. And listen, this fundamental principle does not only apply to paying off a loan. This fundamental formula also applies to your savings and your investing. So if you keep investing steadily, and you're investing in, it's like the stock market that's not doing 4%, it's doing 10%, 30%. Like today's numbers is astounding. Uh, you know, you could be earning 20% a year easily in the stock market. Imagine what would your numbers would be 30 years from now if you really adopted this program and were a steady investor, putting money in every single month and letting it grow, compounding over time. Powerful, powerful stuff. All right. So the next tactic is going to be very simple. Now that you understand and you can play the what if game, right? You have the tools now at your fingertips to play the what if games. Now you can make the decision, should I refinance? Because every time you refinance, they're going to add money either to your loan or you're going to come up with money at the settlement table. Okay? You don't refinance for free. So is it worth it to you to refinance? Maybe you can use the tool I just showed you and say, well, instead of refinancing, I will just put more towards my loan. Now, maybe that's a good choice. Maybe it's not. Because you have to look at it and say, okay, if I lower my payment, for example, by refinancing, how many months of a lower payment will offset the charges of the refinance? Right? How long do I plan to stay in this house? How long do I plan to have this mortgage to make up the cost of refinancing? You have to balance everything to find out what choice is right for you. Are the interest rates dropping? And if so, do you think there's a chance they may continue to drop? So maybe you should delay your refinance. Or are interest rates rising? Should I lock into a lower rate now before they go higher? It'd be nice and easy if you had a working crystal ball, but we don't. So you need to look at all of these factors and make the right decision. And again, I always advise talking to a professional financial planner and helping them navigate you through all of these decision points to come to the decision that's right for you. But do understand that refinancing, if you have equity in your home, could be a great way to get to some low interest rate money to pay off all of that high consumer debt. Just remember now you're going to be paying for this stuff for 30 years, right? It's bundled into your mortgage. If you take money out of a refinance to pay off your credit cards, which if you followed a good plan, you'd be credit card debt free in a couple of years, but you're going to be paying 20%, 30% interest. Whereas take the money out of your mortgage, pay off those credit cards, and now you're going to be paying 3, 4% for the next 30 years. You got to do the balance, right? But it's so good. If you can drop your interest rate significantly, that you can pay off all of your debts and lower your monthly mortgage payment and end up debt free other than your house, it's a pretty good decision. Very powerful stuff. Okay, and if you're considering refinancing or buying your first home and taking your first mortgage, the question is always going to come up, should I take a 30 or 15-year mortgage? Most commonly, people take 30 only because it has a lower payment, right? You stretch your loan out over more time, they can charge you a smaller monthly payment, but of course, the total amount that you pay will be significantly higher, right? So remember, for a cheaper monthly payment, you're going to pay more on the back end, whether you're talking about a car payment or a home mortgage. The theory is the same. But what might surprise you is learning that a 15-year mortgage that you pay off in half the time does not translate to twice as big of a house payment. It's only about 30% more. Again, this is the power of compounding interest over time. And a 15-year mortgage usually is offered to you at a lower interest rate than a 30. So if you can afford a 30% higher mortgage payment, monthly mortgage payment, over the 30-year loan, I wholeheartedly support you grabbing a 15-year loan. But if you can't, don't despair. because life is fluid. Okay? Life is fluid. And you may not have the money today, as long as you live in a state where you can pay extra towards your principal without any penalty. It's called a non-prepayment penalty. You can always just add more to your monthly payment and drive the term of your loan lower, just like we did in that earlier exercise of adding $100 a month. Okay, so if you don't qualify for a 15-year, or you're not comfortable being obligated to a 30% higher monthly payment, you can go ahead and rest assured that you're not doing a bad thing by taking a 30-year mortgage. You're committing yourself to a smaller number. Should you ever fall upon financial hard times, you can come up with a 30% smaller house payment. But when it's not hard times, you can pay extra and bring your payment down. How easily is this? Quick math. Take one payment, whatever that amount is, divide it by 12, right? And add that to your monthly payment. So you're effectively making one extra mortgage payment a year. If you do that, you shave 5 years off the back end of your loan. And you turn a 30-year mortgage into a 25-year mortgage. And of course, you can accelerate that by paying more as your finances free up, as your lifestyle permits, and it gives you a little sense of more control with less monthly obligation should bad times befall you. So just if you do that, just make sure that when you make an extra payment that the bank is applying it directly to principal, not future interest, not future payments, not holding it in escrow for the next month, just immediately applied to principal and diminishing the amount that you owe on the loan. And as you bring the principal down, you are in turn bringing down the outstanding interest because you're now paying interest on a smaller amount of money. All right, big topics today, 23 minutes worth of video. Here's what I need you to do. I need you to go and assess your current mortgage or rent situation. Find out what your home is worth. Find out what the current money is selling for, which means what are the current interest rates for refinancing or buying your first house. Play with that mortgage amortization worksheet and just see for yourself how a little bit of what if money can really make a big difference over time. What if you got a better interest rate? What if you made a few extra payments here or there? What if you added a steady amount of money to your monthly payment? For example, just round up, right? If your mortgage is $938, just round it up to an even $1,000 a month, and let's see what that does for you. Consider your refinancing after learning all of your options. Know all of the fees and the costs. Remember, if you refinance and you take money out, or you put too little down and you don't have that 20% equity, you will trigger the PMI insurance, and realize that you can build up some wealth through personal residential real estate and sell it with zero capital gains. So you can really make this system work to your advantage, knowing that real estate has always been the foundation of wealth building in the United States. Now you can be part of the a player in the game. You can be part of the game. All right, got a lot to do. Some powerful stuff could make a big difference. Execute now. There'll be no change to your life without corrective action on your part. Thanks for watching. We're going to see you back. I only got a couple more days.